Can your investments have a positive impact on the world? At Standard Chartered, we believe money can be a force for good. Through your sustainable investments with us, we're financing hospitals that are the heartbeat of local communities, funding clean energy to make electricity more accessible, and investing in innovative solutions to clean polluted marine habitats. Sustainable investments that benefit you and parts of the world that need it most. We're Standard Chartered, and we're here for good.
Hello, and a very warm welcome to everyone tuning in from all over the world. I'm Manisha Tank, and I want to say it's great to have you with us at the Emerging Markets 2022 Investment Strategies for a Brave New World event. It is brought to you by Bloomberg Media Brand Experiences and proudly sponsored by Standard Chartered. We've got 3 stimulating sessions on the slate for you today, and I'm really excited to get into them. First, an in-depth discussion on emerging markets in Asia, Africa, and the Middle East. Then we have a deep dive into China. That's happening at 9 a.m. Eastern Standard Time. And then at 10 a.m. EST, we'll have a look at Africa and the huge opportunities there. We've received lots of questions, really interesting ones, and we're going to be weaving them into the conversation. That happened during registration. So glad you sent those in, and we'll try to address as many of those as we possibly can. I'd also like to encourage everyone who's listening live right now to submit your questions as well in our active Q&A. We have a Q&A feature. You can just click on that and feel free to use it to submit those questions throughout the session. It might be in response to something you've heard, or you perhaps have a further inquiry about something you haven't heard about. And I'm going to do my best to make sure that it's all addressed. Well, it's really good to have you here to talk about some really important issues. The economic disruption caused by the pandemic has lasted longer for emerging markets than the advanced economies in China. There is some pessimism around in some quarters, but EM investments can be an attractive proposition. That is something we will be exploring in depth. Over the next 40 minutes or so, we're going to get a lay of the land, and then we're going to explain why emerging markets have so much to offer. So joining us for the first session to get us this overview, we have Eric Robertson, who's Global Head of Research, Chief Strategist at Standard Chartered. We'll also get a special angle on India, particularly in the wake of massive lockdowns, with Sharad Desai, who's Global Head of Financial Market Sales for Standard Chartered. He's with me in the studio, which is a real treat. Nice to see you. Nick Eisinger joins us online. He's Principal Emerging Markets, Active Fixed Income at Vanguard, and will talk to us a little bit more about how you construct a portfolio amidst such uncertain times. I'm really looking forward to hearing about that and much more. Yakov Arnopolin is Portfolio Manager, Emerging Markets at PIMCO, and will share how to get it right from ESG to navigating a possible debt crisis, which is something we've been talking a lot about recently. So I actually want to take it to our panel online, first of all. And Eric, who I've had the pleasure of speaking to you many times. Eric, I often turn to you to get a real overview of what's happening. And that's what I want to do again today. But it added to that, getting that sort of status report on EM right now, I also want to weave in a question that we got during registration, which was around how there have been so many headlines coming out of China and how that's developed and how EM currencies are reacting to all of this talk about the Fed taper. I mean, this person wants your general forecast about EM, but I think a lot of these news headlines that we've been talking about recently has been feeding in to that status report. How's it going?
Yeah, sure. Thank you, Manisha, and thanks everyone for joining us today. Look, coming into 2021, there was quite a bit of optimism around emerging markets, both from an economic point of view and from an investment opportunity point of view. We'd had a fairly spectacular recovery out of COVID from China. We were seeing global trade recover at a much faster pace than we saw coming out of the financial crisis. And so the view was that with the improvement in commodities, with the improvements in global trade, that the stage was really set for a meaningful recovery in emerging markets. And as we've learned throughout the year, whether we're talking about emerging market equities, local currency, fixed income, or foreign exchange, the challenges have outweighed the opportunities, or the challenges have outweighed the prospect of successful returns. In many ways, we've seen the worst performance for EM since 2013, when we had the taper tantrum. MSCI EM lags by the greatest margin against the S&P since 2013. So the question is, with so many good prospects to start the year, what is the value proposition for EM if we can't log good performance, even with supposedly good fundamentals? And as you point out, Manisha, there's some very high-profile challenges which have hit us throughout the year. Number one is the slowdown in China, including a regulatory crackdown on a number of sectors. There have been growing and increasing fears around not only the Fed's tapering agenda, but also the surge in short-term interest rates across developed markets. And finally, I think it goes without saying that for both EM and developed markets, the fear of inflation has become probably the number one concern as we move into the final quarter of the year. And that has really weighed on a number of emerging market currencies as well as local currency debt markets. And so as we head into 2022, I think the question is not so much will growth be good enough, but will a number of the other factors and risks that have weighed on emerging markets fall to the wayside. China remains a considerable risk from a growth point of view, but I think more importantly, we need to see a return of investor capital to EM. We've seen persistent outflows throughout the year. So we believe valuations are attractive. We believe there are terrific opportunities for harvesting risk premia. We believe there are terrific opportunities in Asia specifically, and even still within China. But it's going to be on a case-by-case basis, and this is where the macro becomes really important.
Yeah, absolutely. Case by case, it also sounds like you're going to have nerves of steel. Speaking of which, why don't we cross to Nick? Because Nick, it's lovely to talk to you. There is a lot of cash out there, and there are those who want to make those right investments. And I think Eric has pointed that out, right? That it depends on what you're doing, and you have to be pretty specific about what you're targeting. Here you are, and again, lots of negative news flow. How do you start constructing a portfolio with all of that uncertainty and with everything that Eric just put on the list there that we need to worry about?
Well, thank you for having me. Those are great questions. They're very pertinent questions. I mean, at the moment, the best way really to go about constructing the portfolio is to remain, I think, quite cautious. Some of the risk factors that Eric has outlined are clearly still with us across emerging markets. You know, it hasn't had that growth bounce back that people thought may happen. That's partly because of differentiations in vaccinations and other factors. That may well happen, but it hasn't happened yet. And we generally know from history that when the Fed starts to signal that it's going to get a bit more hawkish, EM generally struggles. So EM has anticipated some of this, particularly if you look at monetary policy. Many of the central banks have started to move. The Russians were probably one of the first movers. But even those first movers that we saw with the Russian central bank, very clear from what's happened over the past week that we're not quite at the end. There were some people in the market trying to take a view that, you know, the policy cycle in Russia was near an end, but it's not. So I think this normalization that first started in EM is going to take a little bit longer. And I think you really want that wave to pass over you. So the overall strategy, I think, has to be one where you should be very cautious about taking too much market direction at this stage, or put a different way, the sensitivity of your portfolio, if you run against a benchmark, for example, the sensitivity to that underlying benchmark should probably be quite close to 1, your beta, in other words, because you do want to have trading positions. You want to probably have a bit of an up in liquidity bias. That's something you probably always want to have in portfolio construction, but that gives you great opportunities. And by not having an up in liquidity bias in your portfolio, meaning being heavily involved in some of the less liquid names that might take a long time to turn around, to come in and out of, that removes great opportunity. It removes dry powder from your portfolio. And then just a couple of statements on the broader asset classes. I guess the benefit of EM being a little bit of a first mover is we are starting to see some opportunities open up, particularly in high yield credit. We've seen some cheapening up across a number of those names. Quite often that cheapening up, you need to be very careful about the country selection, but also what parts of the curve you're invested in. and maybe we can talk a little bit about specifics later on. So I think there's some value beginning to show up in EM high yields. You need to be careful. EM rates, I think, is still a pretty dangerous place until we get a better sense of where the Fed really is moving. We're probably going to get a bit of a better sense once tapering starts, probably quite imminently. And EMFX, I think, is a little bit more of a mixed bag at the moment. Eventually, those will be interesting opportunities, but we think there's a little bit of that show still to run before you can start getting, meaningfully constructive back into the asset class.
Yeah, so I get the sense that you need to sort of maintain a bit of agility. And you talked about perhaps getting into specific issues yet. I mean, there's no time like the present. Because I wanted to put to you one of the questions that we received during registration, and it was quite specifically about everyone, of course, talking about supply chain issues at the moment and how they affect EM countries, and whether or not the shipping market was playing a big role for these countries. Is that something you've thought about at all?
Tangentially, we do think around those issues. I would say it's much more to do with the effect of sort of broader supply chain issues, restrictions, lockdowns that are still, somewhat relevant in a large part of EM, and the associated inflationary pressures that we're seeing. So, it's easy to paint a picture right now where EM kind of has far fewer options. EM is a little bit out on its own now because it's clear that developed market monetary policy is no longer going to be playing the supportive role for EM that it did over the past 5 or so years. Secondly, the market is pretty condemning of any EM country that doesn't really have a fiscal plan. We've seen that most recently in the Ghana credit market, where the market has really questioned their resolve to reduce their deficits and their funding needs going forward. And that market has been severely punished over the past couple of weeks. And at the same time, we've already mentioned it, on the monetary side, EM's been the first mover. In the past, I guess, EM would have perhaps reacted more to what the Fed has done or is about to do, as opposed to this time around, it's trying to anticipate it. So you see 3 big pillars of support for EM that I guess the market's become used to over the past 10 years are suddenly getting much, much weaker. Now, the good news, of course, is that's beginning to be reflected in some of the pricing, as I said already, in the high yield. I don't think it's been reflected in EMIG space, so the higher quality EM sovereigns. To us, that's an area to be pretty cautious on. Obviously, that's also an area that's much more sensitive to underlying US Treasury moves as well. But the good news, as I said, in high yield, you're seeing some opportunities open up. You're not really seeing those opportunities open up in other parts of the global credit markets either, certainly not in USIG, and not really in US high yield either. So that's part of the relative value play as well for EM right now. Okay.
Well, with that, let's move on to Yakov, and thanks so much for that, Nick. From your point of view, from an investment point of view, Yakov, what would you say is the big hangover that we're dealing with in the midst of COVID? I almost said post-COVID, but we're still not at all post-COVID, really, are we? And I think that's partly the problem. What are you particularly mindful of at the moment?
Yeah, of course. Well, good evening to the audience in Asia. Good afternoon to those of you in Europe, and good morning. A lot to unpack there, but I would say first and foremost, what we're focused on is the slowdown in Chinese growth. And I think what the implication is, that's going to moderate its impact on emerging markets, cyclical conditions. Having said that, I may disagree a bit with Nick there. We're still of the view that developed markets are very much in a lower for longer situation on the rate side. And there is a positive externality for emerging markets, certainly, which is the cost of servicing their debts, which inevitably are significantly higher than pre-COVID. And we're seeing higher debt burdens across the world in developed markets, in emerging markets. But that lower for longer environment in developed markets is keeping debt servicing costs very much in check in emerging markets, and is allowing these countries to actually support significantly higher debt levels. But broadly speaking, I think we are entering this period of much less synchronized global growth than pre-pandemic. much more volatile global growth and inflation than pre-pandemic, which means shorter cycles, less correlation, very much a lot of idiosyncratic developments. So it's interesting. It's more interesting than ever to be an active manager in emerging markets, and also I'd say a lot of regional divergence, a lot of concern about downward growth surprises in China, in Africa, and on the flip side, potentially positive growth surprises in Eastern Europe and in Asia outside China. So there's, it truly is a hangover. Naturally, we're also very focused on inflation and specifically the high proportion of energy and food in emerging market inflation baskets, which may lead to either further subsidies and meaning more pressure on fiscal, or may actually lead to further unrest, further, more populism. So there's certainly a lot of fragility overall post-COVID, but also some interesting opportunities at the individual country level.
Yeah, amidst that fragility then, I'm quite curious. We've had a question in from our audience. What emerging market will likely lead the pack in equity performance in 2022? And I'm thinking from your perspective, there is a lot to put in the pie there in terms of, you mentioned fragility and you mentioned many of the other risks that are on the table, but could you call it? Could you suggest one?
Can I vote for the United States? Does that count? As a practitioner that's more focused on, currencies and fixed income, I would say that, generally speaking, within EM, the preference on a near-term horizon is for, dollar paper, dollar sovereign paper, kind of maybe mixed with corporates, simply because we think it's far more removed from some of these fragilities that we mentioned, and even with the higher debt burdens, there's still certainly room to service that debt. So not concerned about some sort of wave of defaults, but ask about equities and specifically which equity market in EM. When we look at EM equities versus EM debt, something that always is a bit of a red flag to us on the equity side is specifically the benchmark construction and the sort of concentrations you see in EM equity baskets and EM equity indices versus EM debt. In other words, EM debt indices tend to be much more diversified, much less concentrated. That's what we see in EM equity indices, both at the country level, but also at the sector level. So we often see investors actually, move to debt to get greater dispersion and greater diversification.
Yeah, and I think especially now in this environment, even more so potentially. Well, thanks for that, Jakob, and those insights. With all of that, let me turn to my colleague in the studio, Shahid. So nice to see you. Great to be in the studio, and I think that's a marker of where we are in this cycle almost. Okay. Let's talk about India, because it's been a terrible time for India, and it's been in the news, and there's been so much negativity around how COVID had ravaged the country, quite literally, and terrible headlines. Can we expect to see a huge rebound?
So first of all, thank you, Manisha, for the question, and thank you everyone for dialing in. I just want to sort of pick up on some of the points that have been raised by Jakob specifically, and sort of point people to the paradox that has been India over the course of the last 18 months or so. You're absolutely right, massively hit, specifically hit the second time around after it had originally seemed to have done a pretty good job in controlling the spread of the pandemic. But the true paradox is, if you look at the cumulative foreign direct investment flows over the last 3 years, there haven't been 3 years in recorded history where India has had as much inflow in the direct investment route. Secondly, contrary to many other emerging markets, India's portfolio flows into the equity markets have been actually very strong this year, as just inside of 10 billion. And that's actually meant that the Indian equity market has outperformed virtually all emerging markets and is very, very close to the performance of the US equity market. And I call it a paradox because on the underlying growth trajectory in the underlying inflation trajectory in the country, you wouldn't expect to see market performance of the sort you've seen this year. So to the question about whether we can actually bounce back, I think it's going to be a slower grind than people expect, but that's not what the market's telling us. People seem to be voting with their money going into the Indian markets on the back of, I think, what has been perceived as a far more prudent fiscal approach through the pandemic than many other emerging markets have used. In fact, I would argue that the government's in a position today where they must actually use fiscal policy, because monetary policy is going to become a lot harder for the reasons around inflation that we spoke about. But India does have flexibility in fiscal policy because they were very prudent during the pandemic. And it's important to do that pretty much using the American model as a model by going directly to SMEs, which is the sector that's been completely decimated in the Indian economy. So I think there are opportunities in India. As I said, we've seen portfolio flows come through largely on the back of the excitement around many of the policy changes that the regulators have brought into the market over the course of the last few months. It is a significantly under-owned market at present. In the Indian debt markets, government bond markets, are only 1.5% owned by foreign portfolio investors compared to an average of around anywhere between 7 and 40, depending on which market you're talking about. So I do think that, and in fact, over the last 3 to 4 months, we've seen inflows into the Indian debt markets that seem to suggest that people are looking very closely at the government's stated policy of moving towards euro clearability as a first sign of inclusion into various indices that look at these government bond markets that Yakov talked about. Now, were India over the course of the next 12 to 18 months to be included in one of these indices, I think it would immediately shoot up to around a 10% index weightage, because it's a very large domestic debt market, just inside $1 trillion. And as I said, the ownership is extremely low at this point. Excuse me. So I think there is momentum, market momentum, but the only tone of caution that I'd sort of put in there is that with inflation being where it is right now, and with India's large reliance on imported energy, I think this is one of the risk factors that I guess portfolio constructors will have to look at going forward.
So is all of this neutral or to the upside for the rupee? What would be your assessment?
I think if you just look at inflation dynamics and the expectations around a recovery, which would immediately change the current account dynamics, which is currently very, very benign, I think we would tend to see the rupee drift weaker over the course of the next 2 to 3 months. So I think our house forecast is between 74.50 and 75.50, but we expect this could be the risk would be on the downside. So I think the interesting dichotomy between expectations around the currency movements, which is looking at the fundamentals of the economy, and the actual flows of capital, is where I think the exciting prospects going forward in the next few months are.
Yeah, so something for a bit of laser focus. You mentioned energy, though, there,
yes,
and I want to pivot to the subject of energy, because I've got a question for Nick. From an EM perspective, Nick, who benefits or loses? I mean, oil has been in the headlines. We've talked about testing $100. Can we agree that we're going to see elevated levels for some time, and that is going to prove to be a story for emerging markets?
Yeah, it's an important question. I guess there's a couple of framing questions to that, or framing statements. So the first is whether oil does, let's say, go to 100, how long it stays there for. The second, perhaps more important question, is whether the market considers that at some stage in the coming weeks or months to be an important market theme or a macro theme. That's important because whether it gets to 100 or not is kind of immaterial, because the market will trade around those factors for a period of time. So I guess the first thing to say about $100 oil, let's use that as a round number, is that it's going to fuel the global inflation debate, obviously. Potentially it has implications at the Fed and so on. So that's the first consideration. When we then think about the more detailed application of that to emerging markets, there's probably no great surprise that you're going to get a basket of winners and a basket of losers. It's a little bit hard to make really detailed assumptions because, you'd usually look at the budget, you'd look at the balance of payments. You also have to make certain assumptions about whether governments would spend that additional windfall or whether they'd be prudent. So there's a lot of moving parts. There's lots of subsidies and so on going across. But I mean, at a high level, clearly the countries that benefit, let's stay to the sort of high yield part of the market. That's Nigeria, that's Gabon, that's Angola, that's Oman out in the Gulf, that's Bahrain. And actually you can see a situation where all of these countries are either already or, are very close to generating both fiscal and current account surpluses under $100 oil scenario. I don't think that's in the price of many of the hard currency bonds of most of those countries. And then on the other side of the ledger, I guess you've got also the usual candidates who suffer when oil prices go up. So the energy importers, and particularly the energy importers, which also have large external funding needs. So Turkey is a very obvious one there. Turkey's actually managed to keep the current account position relatively in check, but that potentially gets hit by a large increase in oil prices. So that adds to their already very large funding need. So I don't think $100 oil is in the price of Turkish bonds right now. Now, Turkey has a whole range of other policy options, policy challenges and issues, big short-term debt rollover needs and so on. So this will exacerbate that situation. To us, a country like Egypt, at the margin, is a little bit worse off, probably on the fiscal side when oil goes up, although Egypt more or less imports and exports the same kind of amounts of oil. So externally, it's probably okay, but they do have a very large funding need, as we know. And Ukraine, one of our favorite trades actually in the market still right now for convergence reasons, and for the reform momentum. But if Ukraine has a bad winter, oil prices and gas prices in particular do spike, that certainly will lead to additional funding needs. Now, I'm pretty confident that Ukraine would be able to address that and be able to finance that. Obviously, they've got the IMF back on board. They're about to join the GBIEM in a small dose, at least going into next year. So there will be more demand and ability for them to finance. But $100 oil is a bit of a mixed bag as you look across our region.
Yeah, I suppose it depends on which side of that equation you're on. You also mentioned whether or not Ukraine has a bad winter. I'm glad you brought up the weather, because I'm going to transition to speaking about climate change. Yakov, I want to get into this with you, actually. As we talk about energy, of course, we have to acknowledge that emerging markets are some of the most vulnerable to the huge changes that are going on in our weather systems right now. What is your position on ESG, and how are you mitigating the extra risk involved? And it was interesting because I heard, I was talking about energy markets the other day and realizing that actually that investment into extra capacity isn't happening in the way it did before, because obviously we're transitioning to this net zero, we're transitioning to a more sustainable global economy, and that means things are going to have to change.
Yeah, look, it's obviously a very relevant question, and I think first and foremost, I'll just to frame it, to us still, most of the investment in clean tech, green tech, renewables, whatever you want to call it, is going to come from developed markets, just realistically, because that's where the focus is, that's where the money is. Having said that, still very positive for many emerging markets via the export channel, via the financing channel. So there will certainly be spillover, positive spillover from that standpoint. And you can almost think of it as there's some equivalence to thinking back to early 2000s, the early noughties, when China had this huge demand shock, more focused on metals and commodities as well. This one is probably going to be more narrow in scope, but also longer lasting, because of this kind of hopefully permanent transition to cleaner technology. Now, I'm not breaking any new ground here. That's saying clean tech, is naturally quite positive for various metals and mining products, whether that's copper, nickel, cobalt, lithium. So we'll benefit all of those producers. But we are in a state of the market where, as we've just seen, the fact that you've had a backlash in developed markets against any sort of brown technology, fossil fuel technology, has also made those countries, has also made the supply of traditional, more polluting energy, has made that supply less elastic, more inelastic, unable to respond to vagaries in demand, to acceleration of demand. We're witnessing that right now. So conversely, you kind of have two things going on. This is benefiting a lot of the lower cost brown energy producers in emerging markets, whether that's GCC, Russia, or some of the African countries. It's also longer term, and it has a positive impact on metals and mining producers from this ESG angle that I mentioned. And also any country that is specifically very focused on its ESG credentials, Uruguay comes to mind. So it's right now, I think it's a bit of a barbell, low cost brown and either metals and mining, or kind of ESG focused countries that are benefiting. Now thinking about the brown tail of that barbell, this is also stimulating the very same economies. Whether you're Russia or so on, it allows them to pursue some of their net zero goals via stronger growth, via better external balances. So ultimately, this actually allows the brown to go green. This is not a 6 month obviously transition or a 12-month transition, but nonetheless, there is a positive stimulus and a positive kick, so to speak, from these high energy prices, allowing fossil fuel producers to go green. Now, again, on the ESG side, obviously huge focus for us, huge focus for PIMCO, and something we're witnessing is, generally speaking, the pool of AUM that is either able or willing to finance fossil fuels or any sort of controversial names is shrinking very fast, either because of exclusion lists or additional sensitivities or more red flags. And I think that's going to be the trend going forward now. And then in similar fashion, I think it's sometimes difficult for countries or companies to get the message very quickly, i.e., their financing costs will grow over time as a pool of capital that is eligible or available to be deployed to buy their bonds to finance them shrinks. But I think we're seeing more and more people wake up to that. Now, there is obviously the Belarus of the world that have significant controversies. I don't see Belarus changing their policies because they're locked out of markets. They're locked out of capital markets. They're looking for alternative financing. But certainly at the corporate side and increasingly on the sovereign side, the engagement is there, and I think there is a lot more understanding, sophistication from the issuer side. And when I say understanding, that means understanding of the implications of not moving fast enough and on the green front, on the ESG front, and the sort of ramifications it could have for various countries' financing needs and financing costs.
Yep, there's certainly an urgency. But I see that there's actually still a debate on this kind of thing. Let's move on to distressed markets. And I want to take it back to you, Nick. We've yet to see some of this actually reflected and priced in. Will we see a more reliable assessment, do you think, of the position of distressed markets? I mean, what can you tell us, given the kind of numbers and the kind of data you're looking at?
Yeah, very good question. I guess the most recent set of comments are really based around some of the expected recovery rates. If you just look at market prices that we're seeing out of, places like Zambia, which is somewhat curious given that Zambia is still, very much at the beginning of that negotiating process. As we all know, Zambia has approached investors for some kind of reprofiling, a haircut, etc., still to get an IMF program. I think, to be honest, still to disclose the full extent of all of its debts as well. So I would just say be a little bit cautious and careful with what you're seeing in terms of, what you're seeing on the screen prices and whether we think that really reflects a realistic recovery rate when these guys eventually come out of on the other side. At the other side of the spectrum, obviously, you've got a country like Lebanon, which clearly has a huge range of additional problems over and above what we've seen in Zambia. Those bonds move around a little bit according to what's happening politically, but again, no real prospect anytime soon for anything meaningful to happen there. Sri Lanka clearly on the horizon. Will it? Won't it? Avoid it? Unclear. It obviously keeps getting some money in from foreign countries to support the balance of payments. That buys it a little bit more time. We do think that there's probably going to be some reprofiling exercise or restructuring exercise there before too long. But all of these are relatively well flagged. So the interesting thing for the markets is to really work out, or for EM investors such as ourselves, are there any candidates out there where it's not yet in the price, but where there's a plausible situation in the next couple of years where they really struggle? And I guess the most obvious one, for me at least, is Ghana. Now, that does not mean that that's going to happen. Neither does that mean that's necessarily our base case that Ghana goes through a reprofiling. But you can certainly paint a scenario where that does happen. And we have begun to see the market trade a little bit in that direction. In credit, you've seen a big inversion of the yield curve over the past couple of weeks. That actually has started to reverse over the past 2 or 3 trading sessions, which I think tells you something about the broader resilience of EM right now. And despite the challenging backdrop, some of it is still quite benign. But Ghana would certainly be one to be watching for. And I think the signals are very clear. You start to get more and more inversion of the yield curves there as investors start to worry about dollar price of the bonds. That doesn't necessarily mean you'd be fully protected by buying long-dated bonds in Ghana from that situation. It does give you a little bit of protection. So Ghana's one. There's likely to be a few others over the next 3 to 4 years, if only just because when you look at the wave of borrowing that a lot of the frontier markets have done, a lot of those start to mature in around 2023, 2024. So there's a big kind of spike in the repayment burden over the next 24, 36 months. So I think what you want to see from a market perspective, clearly you want to see better external conditions for EM, and who knows where we'll be in a couple of years. I think you also want to start to see maybe countries go down the route of more liability management, and we've seen a lot of that in the past 18 months, meaning a lot of countries that are trying to refinance nearer-term maturities for longer-dated maturities, because that obviously helps their profile somewhat.
Yeah, I get the impression that actually there's a lot there. There's a lot of opportunity, certainly, but it's all, again, it's something you said earlier. It's about really picking and choosing and being very specific. Okay, let's take it out for that broader perspective again. Eric, who has been waiting patiently, let's consider on a really, really broad level how we consider, say, Asia versus Africa, or say the Middle East. And I know that this is a really loaded question, because from everything we're hearing, actually, you just cannot take a cookie-cutter approach to emerging markets right now. And I'm asking you to do exactly that to a certain extent.
Well, look, what I think I'd like to do is incorporate some of the comments that we've heard from both Nick and Yakov in terms of some of the tools that we might use to do that differentiation. And one is with regards to debt management and the increase in debt outstanding that we've seen over the last couple of years. Look, it's no secret that we've seen a significant explosion in debt outstanding, nearly 300 trillion now in global debt outstanding, and debt to GDP ratios around the world are increasing in commensurate fashion. Now, on the positive side, yes, the cost of servicing that debt has remained low, as broadly speaking, interest rates in the DM and EM world have remained low. But I guess a concern that we have going forward is if growth really fails to regain pre-COVID levels, then the growth part of that equation, that debt to GDP equation, really starts to suffer, and then debt to GDP looks that much worse, right? So there is in some ways an implicit hope in EM going forward that we can grow our way out of this increasing debt pile. Now, the good news for Asia and we heard this earlier in the discussion, is that we're actually still relatively constructive on the growth outlook. Now, yes, we know China is slowing, but I think the cyclical impulse in ASEAN and South Asia looks very compelling over the next 18 months. Even in North Asia, excluding China, the economies of Korea, Taiwan look extremely resilient to us, largely because of their dependence or reliance on trade. And so I think there's a very good GDP story, a very good growth story that will help us mitigate some of those debt concerns. In some of the other regions, and Nick touched on this extensively, there are concerns about the growth narrative, and that is going to have major implications for their ability to refinance, to tap new capital, et cetera. And here's the final point I wanted to make. For a number of emerging economies, the ability to implement reforms, the ability to implement investment strategies with regards to clean energy, clean tech, alternative forms of procuring food and energy security, all of those reforms potentially get put on the back burner if they simply can't afford to do it. And so this notion of being able to attract new capital or refinance existing debt in a world of slowing growth is really a problem. And that's probably my biggest concern over the next 2 or 3 years. It's not a short-term concern, but it's a medium-term concern for some of the regions. And so from a relative value point of view, I still find Asia to be a more anti-fragile region, if you will. And Nick spoke quite eloquently earlier about the importance of buffering your portfolios, and I think that's absolutely correct. And so while the sort of high beta opportunities may be in some of the other regions, MENAP, for example, Africa, LATAM even, I think Asia will remain a relatively important part of investor portfolios simply because it will be slightly lower beta. But the ability to count on that growth dividend, I think, is going to be extremely important for EM going forward when we talk about the interplay between growth and debt serviceability.
Yeah, thanks so much for that, Eric. And I also want to thank Christian, who had sent in exactly that question, looking for those comparisons. Sherrod, I want to ask you, because we've also had an audience question, this one from Tiong in Shenzhen, who's interested to know which areas would be good for investment in 2022. And given Standard Chartered's exposure, you seem well placed to have a view on that. Also, how are you helping clients capitalize on those trends?
So I think many of these areas have been touched on by the various panelists over the course of the last 40-odd minutes. But I think just to catch up, to pick off from where Eric left off, in Asia, historically, we've always thought of Asia as being a total return story. It's never necessarily been a high beta play, but it's always been a play on the underlying growth driven to a large extent by trade flows. I think Eric touched on it in his initial comment about how trade at the start of this year picked up quite strongly. And even while there's been a bit of a bump in the middle of the year, we continue to see trade flows, both intra-region and international, looking extremely strong. And I think what we're seeing right now across our footprint, which is largely Asia, the Middle East, and Africa, is that while Asia has stabilized, if not actually completely hit the ball out of the park in terms of growth patterns, we still see a stabilization which is far more conducive to more sustainable growth in the medium term. I think there are still some concerns around countries and parts of our footprint in Africa, but once again, for those countries where there are big upticks from commodity price changes, as Nick pointed out, in places like Nigeria, Angola, we are beginning to see investor appetite coming back in. So from an investment perspective, I think we continue to see a case for investment in Asia and in parts of Africa and parts of our commodity rich countries, because there is demand for metals and mining, there is demand for fossil fuels still, despite what's happening in terms of the various moves towards renewables. So I think there are opportunities in these markets, and I think we will continue to see these opportunities being realized by investors.
Thank you for that, Sherrod. We literally have a minute or so left of this panel, which is a terrible shame because I still have lots of questions to ask. But what I'm going to do is ask for an elevator pitch from both Nick and then Yakov as quickly as you can. If you had to leave our viewers, and you have to leave our viewers with your just final thoughts, but it's got to be elevator pitch style. Nick, what would you say?
Stay cautious for now, but 2022, I think, can be a very interesting market for EM rates once central banks have got there, once the initial phase of the Fed moving has kind of been digested. Hopefully, we'll get a little bit more of the EM growth rebound. I think that's good for high yield. You have to be selective on high yield. And I think equally that can be quite positive for FX once you have that additional carry imputed into the market by the central bank hikes. So 2022 could actually be a pretty interesting year.
Gosh, Nick, you're really good at that. You've been practicing. Yakov, and perhaps we could finish with you. What would you say briefly if you can?
Yeah, of course. Look, as simply as there's more fragility, there's more opportunity for active managers, but at the same time, it goes back to the fact that we always want to summarize emerging markets in one line, but it's 165 countries. Even when something breaks in half of them, something very interesting is going on in the other half. So there's plenty to pick from, and again, still optimistic on the opportunity set, even if ultimately we're also being quite cautious on some of the more fragile names out there.
Yeah, absolutely. Just thank you so much for reminding us of the diversity of these markets we're talking about. Gents, thank you all so much. It just leaves enough time for me to name check you all just one more time. Eric Robertson of Standard Chartered, thank you so much. Head of Research, Chief Strategist. Also, Sherrod Desai, who's with me here in the studio. Thank you so much. Global Head of Financial Market Sales. Nick Eisinger, who is on the line with us, Principal Emerging Markets Active Fixed Income Vanguard. Thank you so much, telling us how to construct that portfolio in difficult times. And Yakov Arnopolin, who's Portfolio Manager, Emerging Market at PIMCO. Thank you so much all for your views today, and thank you to our wonderful audience. Goodbye for now.